Good morning, everyone, and welcome. This is Joe Scarice, Creative Bird Strategy founder and co-host of this great podcast and room here on Clubhouse. I want to thank everybody for coming in live. We're going to get started here in just a few minutes. We're going to invite a ton of people in and get started here. Give me just a quick second, and I'll get some people invited up. Pretty excited for the day. It was a great week. Just got to get my thumbs moving a little quicker here. So we'll get here in just a few minutes. Get started. We're going to have a great discussion understanding commercial real estate, but obviously we have to go through all our introductions and etc. So first, I want to thank everyone for tuning in this week. We're here every Sunday morning, 9 a.m. Eastern Standard Time, providing education, networking, and hopefully some strategies for you to take for the week till next. My name is Joe Scarice. I am a senior loan analyst at Lendmark Capital, providing insight on asset-based lending, non-QM, trying to always identify that next best subject to really put together. We're at over 10,000 members in our group here on Clubhouse. I want to always thank them and recognize them. I want to thank our sponsors, Mr. Yardell Perkins of Perkatech, who provides all our social media architecture and structuring and video production for the podcast. Without him, we would not be here. So reach out to him to have a discussion about social media and a way of attacking social media. And I'll talk about that in just a few minutes and what we're doing as well. And then I want to talk about our other sponsors, such as Miss Linda Pelagas from Realty 411, who provides educational publication throughout the country, a national publication. She offers also educational events throughout the country as well. I want to thank MB Capital with that provides unsecured business lines of credit, where I am a referral partner. Been there quite a while. I've been working with Eric Moss and his team for quite a while. I want to thank the Elite Dealmakers, where I'm also now an affiliate offering events of education throughout Philadelphia, South Jersey, North Jersey, in Lehigh Valley. We're also hopefully assisting a nice young lady that is putting together an event in Central New Jersey. We're also looking at Delaware, and then we're just here to provide and give back, and hopefully provide some insight and direction in our discussions. So I want to thank everybody again. First, let's get some update on some articles first, because we always like to kind of give some insight to what's going on in the market, and I think that's important. From Mortgage News Daily, mortgage rates ended this week at the lowest level since December 18th. It didn't make a much of an impact on home sales. Definitely made an impact on the investor sales, uh, whether fixing the rent, fixing the flip, and or um, DSCR loans. But the rates came below 7% on the 30-year, about 6.89. Commercially, we came down about an eighth. We're somewhere between 6.75 and 7.125, depending on leverage, depending on credit, and depending on the asset type. So keep an eye on the rates. They're going to be very bullish over the next several months. You know, building permits staying fairly calm as housing starts to whipsaw a little bit. Refinance applications still near best level since October, but I think a lot of that is on the investor side. Um, I think we still have to yet see what Doge unveils with a lot of the fraud that's out there in the government and thinning up the government costs. Mortgage delinquency rates decreased in January. Home price growth has slowed, but high cost economic worries have some buyers, retreating. So that's where the investors are kind of forging forward. Single family builder rent construction falls back a little bit, but I think that a lot of those developers are going more toward the opportunities in the conversion space, office, retail, or commercial, going to residential mixed use. So that's an opinion. I could be wrong. Another article that caught my eye that I think maybe keep an eye out, digging up zombie foreclosure data for quarter one. Some around 1.4 million residential properties in the U.S. remain unoccupied. I'll be posting that article today. I thought that was an interesting scenario as well. So again, a lot of things going on. I've been various places actually in the last week. I've been in Connecticut, I've been in New York, I've been in PA, I've been in New Jersey. I went to a great event yesterday in the Sub 2 community in New York with a great group of guys, Chris and Miles. They put this great event together on Fifth Avenue up on the third floor at the Compass Real Estate office. We had about 100 people there networking. There was a lot of excitement, a lot of discussion about door knocking and creative ways of getting in front of people. I thought the event was well run. Everybody was involved. A lot of questions going back and forth. Good questions, not just like silly questions. Um, I also met with guys from the Connecticut RIA. Hopefully, we'll be hosting an event in Connecticut on behalf of Connecticut RIA at our offices in Westport, Connecticut at Landmark. Very excited about that discussion. Some of the RIAs are understanding they have to evolve with the market and change with the market, and I think that's a very smart move for them because they don't get ahead of the game, they're going to get behind the game, and a lot of these smaller investor groups are kind of creeping up. Then I spoke with a group of investors yesterday as well. We're looking at the Delaware market as well to putting together an educational portal event on a on a monthly basis. So I'm excited about that discussion. But um, I think this is a very unique opportunity to put together a good group of experts in a lot of circumstances. And today I met Antonio. I think it's got to be over 6 years ago because I'll be celebrating my stroke survival May 15th, 2019, the sixth year this coming up May. So I met him before that. So at least I've known Antonio Dicianni for over 7, 8 years. We did a bunch of panels together discussing commercial real estate with himself and his partner Glenn. And then we had another great guy that was from MW Law we discussed syndication back in the day. Nershan Mashant, or I forgot his name, but a great attorney. We had some great discussions. But so I asked Antonio to come on here, provide it, introduce himself, and then I'll pose some questions to him, and then we'll open it up to the audience if anybody would like to raise your hand and put some questions to Antonio or any of our other moderators. I would greatly appreciate it. Antonio, good morning and welcome.
Hey, Joe.
Can you hear me? Okay.
Yeah, man. How are you?
Good,
It's
good.
been that long.
And it's been a long time. I met you at Andy's Diner. That's got to be what, 8, 9 years ago,
Yeah,
and
a
about
long time ago.
and
That's
about
right.
150 pounds ago. So
Yeah. You look at me, looking slim and trim right now.
trying, going to the gym every day, taking care of my health is a priority, as you know. So Antonio, why don't you give a background of who you are, what you do, what's your team about or your company about, and then we'll dive into some questions I put together. Nothing too
Cool.
complicated. We're going to keep it high level. But give it an overview of who you are, what you do, and then we'll go into some questions and then we'll open it up to the moderators as well.
Cool. Thanks, Joe. Yeah, good morning, everybody. Good to connect with everybody here today. My name, like Joe said, is Antonio Dicianni. I am founding partner in a company called Suburban City Group. We're sort of a collection of we like to call modern real estate companies. So our core background, our core business is brokerage, commercial brokerage. So we built a platform that kind of operates in a boutique space, small firm, about 7 people, number of agents, and then support staff. We focus mostly geographically for the majority of business that the brokerage firm does. We really take sort of an advisory approach to how we operate. So I have a pretty deep background in investment management, real estate investment management, asset management, and development. And part of our platform is also focused on that, developing investment and development deals, mostly in the multifamily mixed use and built for rent space. But we leverage all that background, bring it into the brokerage side, and take really, like I said, an advisory sort of consulting approach to brokerage. So sales, leasing, and consulting throughout the process. So mostly focused on Philly and the surrounding counties into Jersey, Delaware. But we've done deals across the U.S. Just sort of depends on what.
So, Antonio, let me dive into this. So, you don't really have boundaries when it comes to commercial real estate as a real estate agent, correct? Like you could do a transaction almost in any state in the country if it makes sense because of the way the commercial environment works. Can you give us a little how that works a little bit and and how that it doesn't translate the same way with the residential investor, realtor,
Yeah.
agent as well.
Yeah, so from a licensing law perspective, you're still restrained to the states in which you're licensed, whether you're commercial or residential. However, on the commercial side, it's a lot easier, and we've done this, developed relationships and partnerships where we can leverage partner licenses in other parts of the state, other parts of the country, excuse me, in other states. On the investment and development side, when we do things principally, not acting as a broker for a third party, for client, then there's no boundaries whatsoever. But if we're doing business in other parts of the country, we link up with people in our network that we've developed over the course of years and years, that allow us to basically partner licensing wise, and get deals done. There's also third party services out there that allow you to do that too. That you can just sort of pay a fee and work through. But there's ways to do it. It's much less restrictive. There are still rules that you have to follow, but it's much less restrictive on the commercial side.
So, I mean, this whole NAR settlement didn't even put a blip into your screen whatsoever because commercial doesn't even get impacted by that whole minutia of the lawsuit for the residential
Yeah.
agent. It never had anything to do with you guys at all, right?
No, I mean we've always the commercial world always operated um, in a different way anyway when it came to commissions and fee agreements and representation. I mean, day one, we're getting fee agreements signed and representation agreements. Just depends on what we're working on. But whether you're a buyer or a seller, like that's commonplace. That's every day. That's like step number one sometimes on what we do. So yeah, the NAR settlement really had no impact on us whatsoever.
So we're going to go right to the jugular here because you know how I approach things, Antonio. So,
Yeah.
um, how far will non-QM lending take real estate investors in 2025 with somebody like yourself and your team? Like, how much of non-QM lending has impacted your business, and where do you see it going? Are you looking at smaller assets because it's easier to kind of control the narrative in lending perspective, or is that not even making an impact on your radar?
Um, Lending is difficult on the commercial side. It's as you know, like on the commercial side, different from the residential. It's a financial exercise, right? It's like a math problem every single time, all day. So it's really sort of the key. I think a lot of people have focused on trying to do smaller deals because of that, and I think they're still out there to do. Like liquidity's there, like cash is there to put out, both on I think the debt and the equity side, but it's difficult. It's still difficult with where you know treasuries are at, and the indexes has moved obviously, and occasionally spreads that to do deals. So like those big deals are getting done by big, really qualified, highly liquid, different risk profile type groups. But like the private capital world it's difficult. So yeah, I would probably say there's been some shift to doing some smaller deals.
Well, I'm seeing the small balance space. We're going now up to 20 units on DSCR
Uh,
multifamily. How does that translate to you? Because we don't concern ourselves with cap rate. We're very focused on the DSCR, right? We don't cap rate is kind of almost irrelevant to what we do in the lending landscape on non-QM. I mean, knowing that you can go up to 20 units in DSCR, does that savor timelines in negotiation of closing? Because I mean, like a DSCR loan could close in 30 to 40 days, where if you go Freddie Fannie, that's
oh
probably
God,
that's 60 to 90 days, right? At least
yeah.
if everything goes well, right? I mean, are you seeing rates different now from new? I mean, like, are the banks actually involved anymore, or the banks kind of got pushed up to the side as a kind of a secondary or third option? Does everybody look
Yeah,
alternative now in
I
your
think you're
space?
right. I think you're right. I think like unless you're a sponsor borrower who's got really deep relationship with those banks, like you've done a lot of business, you hold a lot of accounts there. Maybe you've got an operating business that you run through there as well, and the bank doesn't want to see those accounts go elsewhere. those are the only banks that I'm seeing right now, at least, that are being really competitive, and that's not even really competitive, just sort of trying to get deals done.
Yeah.
Although otherwise, yeah, it's the other route, the other world that you got to go to. There's been a lot. I think there's been some debt funds that are starting to come out again, and pick up lending pretty significantly, because you need to go to that alternative route. But yeah, I think like non QM is a good source, and if you're a borrower and you're bidding on a deal, and you can go a non QM route, and you can bring that speed. That's important. I mean, when you're a seller on the other side, you're looking at either you're looking at terms of your offer, terms of the structure of the deal, but you're mostly largely, you can boil it down to being focused on two things as a seller, like price and timeline. And if you can be competitive on price, then it maybe gives you as a buyer a little bit of edge or sorry, if you can be competitive on timeline, with a non QM loan, you can maybe get a little bit of an edge on price. And sellers are generally responsive to that.
So it leads into my next question. Like, where can investing in multifamily properties go wrong or go right? So what are some of the drawbacks? I mean, there's pros and cons to everything. Everybody thinks, hey, I'm going to go create a syndication. I'm going to go buy a multifamily and put together 20 people that are going to believe in what I'm doing here. I know that, and that you have a lot of these people that call you with pie in the sky dreams and fantasies. But let's
Yeah.
bring it into reality. I mean, is multifamily the way to go right now, or is there some drawbacks with all the conversions and all the office retail conversions, maybe potentially going to residential? Like, where are you seeing the sweet spot for the guy or gal that wants to be in that 5 through 20 space? And if they want to go about 20, where should they be? What should they be looking for, kind of thing? Like, how are you advising people in that multifamily not to go wrong? How about that?
Yeah, that's a good question. So I think to answer the first part of that is, all right, I'll open it by telling you a quick story. My first syndication I ever did was like a Class C that we were trying to take to like a Class B deal. It was small, 30 units, and it was old and run down, and the prior owner had done like a lipstick job on it, and it was a syndication. Went out to friends and family, and probably 6 months into it, it was a central boiler system in the building. The boiler went, and it was something that we missed during due diligence. And like, I'm telling this story because when you in syndications, one of, I think, the biggest issues is, where do you get all this liquidity from when you need it? And because you've syndicated out to 15, 20, 30, 40 people who wrote you maybe, it depends how low you went, but 25, 35, 40, $50,000 checks. The boiler goes, and it's like, well, where do you go to get the money you need to replace it when you didn't budget for it properly and have the right kind of reserves? And it's like, good luck going to all these individual people that mostly are friends and family when you're starting out, and you're asking everybody to put up, another 10 grand each. And and then you just layer on top, it's your first deal or whatever, and you're just starting out, and you have personal relationships. It makes it really tough. So I'm telling this story because I think, I quickly learned that one of the biggest challenges and mistakes not to make, especially in today's market where there is a lot of volatility on rates and candidly values. I think people think they're settling a bit, and I sort of think that too. But it's still volatility nonetheless. Nobody knows. Um, and there's a lot of product, obviously, as you know, Joe, that's out there right now. It's getting delivered and being redeveloped. So I think one of those biggest risks, it's always been this way, even more so now, is liquidity as a sponsor who's doing a syndication. So I think you mitigate that by being a little less aggressive on your leverage, bring a little bit more equity to the table. Go a little lower leverage. Make sure your coverage. I mean, if you're doing a DSCR loan and you know where your coverage needs to be, but maybe you don't get so aggressive. Go out and raise a little bit of money from a couple more people. Be a little aggressive. Have a little more reserves so you can manage around that stuff. I still think if you're doing deals today as a sponsor, once again, that 20 to 30 space, I still think if you're doing deals today, just good quality, I personally like Class B and A minus assets. Not the top of the market by any means, but like assets that are in good condition, that have largely well put together systems in place. From a physical structure that don't need a ridiculous amount of capex, because it's sometimes where you get burned, especially in a market today where your tenants are stressed with their rent to income ratios. They're getting hit in all angles with inflation. Like, how much more can you push? And when you got to go dump $1 million into capex to redo with a whole bunch of systems, you got to recoup that somehow. And how do you recoup it? You push rents. And can your residents bear that in order for you to hit your business plan? So I think there's a lot of money still to be made, and you probably a really nice risk return profile, focusing in a little bit better quality assets, in my opinion, that have still a good value add story behind it, but they're not dilapidated, they're not falling apart, there's not a huge risk profile associated with them.
Yeah, I mean, I'm seeing I personally think that like markets like Philadelphia are going to flood with rentals over the next 12 to, I mean, there's so much inventory coming to the front line institutionally or privately.
Yeah,
I see DSCR compressing. I see values coming down no less than 10 to 12% across the board. And I see a welcoming, which you haven't seen before, of affordable housing
yeah,
rents more so than market rents in all the urban settings, even in certain suburban settings. How are you handling that when somebody says, "Oh, I don't want to work with Section 8?" And I'm like, well, I mean, Section 8 is here. It's present. The numbers are almost equivalent to the market rent in most markets outside of the wealthier areas. What is the discussion you're having with somebody knowing all this? Because I mean, I went to an event just, I think it was Thursday night, and bigger developer we both know, Antonio. I think he doesn't see it, him. He's like deer in the headlights right now. Like he goes, Joe, I lost 20% value in all my properties just in the last
yeah,
year. So like,
yeah.
how do you, as a developer, what do you do? I mean,
Sure.
what are you doing here with all this rental compression? Are you discounting everything? Are you looking at Section 8 as the alternative? Like, what are you telling your clients right now in the multifamily, small balance, light mixed use? I know you and I talked a couple of those in the past bit, but what's your thoughts on what I'm thinking about, especially like a
Yeah,
market like Philadelphia, which is kind of relative to 20 other cities in the country?
yeah, definitely. I mean, um, Section 8 is a great route, and I don't know if you're seeing more people consider that and start to explore that never have before, because I think that's a great potential solution. I think it depends on the asset you have at hand, like what kind of product you're dealing with exactly, and where's it at, and you know did you have a certain type of business plan? Has your loan structured? Because that kind of plays into it a bit too. So you got to look at, I really got to take a well-rounded approach to looking at how you pivot to that. But I think that's a great potential solution, and I think people are doing that for sure, like shifting towards that. I'm gonna deal right now. We actually developed in North Carolina that has seen a ridiculous amount of you know new inbound migration. So a ton of people moving there. Like, the fundamentals are really strong, but we delivered, and there's 550 other units that have delivered literally within 12 months of our delivery schedule. So you could bring all the demand in the world. That's just too much supply right now. So we're facing that challenge right now, like a lot of other developers and a lot of our clients. Like, you get hit with all that supply, and you gotta shift your mindset. You do need to start looking at those things. In our case, we just couldn't do it. It doesn't work in that market there. But you start looking at that. You start thinking about, okay, I need to be competitive on my rents. Like, what else can I do? Concessioning obviously is something big. If you structure your concessions right, you can have them burn off and carry as resident credits, so it doesn't impact your top rent roll. After a couple months, nobody even knows it was there anymore. You get creative with other incentives. Like you do gift cards and car wash packages and like all that kind of stuff. You just start to get really creative with how you do it. You get out there and you start working with other businesses in the market, the Chamber of Commerce. Can you get some corporate relationships to put people in? We've even looked at potentially, and I know other clients have looked at this, potentially trying to segment off a couple of units and do short-term rentals temporarily to manage cash flow and get heads and beds. Everybody, all of our clients, including myself, tend to think that we got a huge wave of supply we're dealing with right now, and I don't think it's still coming, but I think the next couple years are going to be see a pretty sharp decline in new supply. So if you can make it through, this challenge, and sometimes that means concessioning and adjusting rents, I think you're going to be as an owner in a really good spot. You just got to get your numbers in place. Sometimes you got to work with your lender, talk to them, so you're not in default on you know renting at certain figures and offer too many concessions. But you gotta be creative, and you gotta really get into the weeds.
So, what investment type are you leaning toward for your clients right now? Like, what do you, like somebody calls you, that you have a relationship. Hey, Antonio, I want to start looking at a new asset. What are you leaning toward right now as a real estate professional?
So in the commercial space, I think I really like, for our clients, and a lot of our clients like small bay industrial, small bay flex. Think about like your contractors, your plumbers, your electricians, your small business users that aren't the Amazons of the world that don't need, 100,000 square feet or even 20,000 square feet for that matter. Simple boxes with a garage door that rolls up and a small little office. Your heart of America type business. I think a lot of our clients and I personally have liked that recently, and I think with with the new administration, I think there's a good bet that that's gonna stay strong. So I really like that as a product type when people ask me that question. I also tend to like mixed use. I mean, I've always liked mixed use because I think you get a nice balance, especially in Philly and the suburbs. You get a nice balance of two asset classes, obviously, especially if you got kind of some retail going on and some commercial. Retail in suburban Philly and Philly has been pretty strong. Everybody focuses on building new apartments, and people developers tend to drop off on the other types of products. So I think that's a good opportunity as well.
So my wish list on with the executive board I had with a discussion this past day, I was up there on Friday talking with them. My wish list is to get a mixed use product, 2 through 8 or 2 through 10. The
Yeah.
concentration shouldn't be more than 30%. I mean, even
Yep.
if we have to go with a DSCR of like 1.35 to justify leverage, maybe up to 70% with 30-year money, it would be extremely competitive because I think there's a lot of downtown corridors
Yeah.
outside of markets like Philadelphia, like the surrounding towns, like the Collingswood like type of towns, and
Yeah.
the Ardmore kind of towns that you have 4 residential and 1 storefront. That storefront is going to stay rented because the community takes care of that area. So
Yep.
like I'm trying to kind of get that on the front line. It's going to take a little while. We have a better chance of seeing a 20 unit multifamily DSCR loan than a
Uh,
mixed use because of the concern of emptiness. I mean,
yeah.
how do you this is going to be one question. We're going to move on to construction lending a little bit, and then we'll get it open to the moderators. But what do you talk to somebody about? Hey, listen, this is a great spot, but the commercial unit is empty. Like, how do you sell that to
Yep.
somebody, as a real estate professional, knowing like, let's go down to South Street right now, and Baskin Robbins was there for 38 years. What do you tell the person that's going to buy that building? You know what I mean?
Yeah.
It's
No, that's a
empty
good
now.
question. I mean, like if you're, most like investor agents tend to come from the residential space, so that you can wrap your head around the apartment side, right, or the fix and flip side. Like the commercial side, it sometimes becomes a whole new unknown world. So I definitely get it. That's a common question. I think you gotta work with, you gotta work, working with an agent who does that kind of leasing, or just connect with somebody about it is key. Just like you would residential comps, look at those lease comps. See where, if that Baskin Robbins moved out, just, where were they paying rent? What's the next couple storefronts next door that have leased at? What have they leased at? Underwrite conservatively to that. Make sure you budget appropriately for the things that go into commercial leasing. Your leasing commissions are much different than residential. Your sometimes you have tenant improvement allowances that you have to give your tenant. You got to do some fit out work for your tenant to get them in there. But the trade off is sometimes if you can get a good tenant, you get a 5-10 year deal with increases, and you're not dealing with turnover. You've got a really solid core lease in there. It sometimes it benefits, depending how you the dynamics. Sometimes it benefits your residential above, and vice versa. So you really got to get comfortable looking at all the data, and you got to underwrite conservatively, budget correctly for a period of vacancy while you're trying to lease up, budget correctly for the costs associated going with trying to lease that space. But in a good market, talking about South Street's a good market. I mean, those vacants don't stay long for that that long,
I'm
so you
hoping
have to
so.
study.
I'm hoping the case. I mean, the Head House Square, I mean, it's just a shame what's going on down there right now. So I hope, over the next
Yeah.
24 months, I mean, the restaurants are filling here and there, but it's still,
Right.
I mean, how many CBD stores can I buy weed from? You know what I mean?
Well,
I
yeah,
mean, I,
yeah, one of those. I guess that's my other question. That's my other comment. Don't lead to one of those because there's like,
I mean, come on. I mean, like, I could buy a pipe everywhere I go. It's like, what do you do here? So, and how many nail salons can you get a pedicure from? You know what I mean?
yeah,
So, like, that's my thought behind a lot of that. So, there's got to be some creativity, and that comes to my next and last question before we go to the moderators and their introductions and potential questions they're going to pose to you is navigating challenges in the construction lending space for real estate investors. I mean, 1 unit up to 1,000 unit multifamily, there's so much money out there, right?
yeah,
More money than deals in fixed to rent, fixed to flip, new construction, 1 through 4, 5 through 20. There's just not enough deals to be brought in with the experience level to close with the amount of money that's available. But where's the challenge for you as a real estate professional in the mixed use piece or the warehousing development? Because guess what, asset-based lenders don't like that stuff right now. They can't sell it back to
yeah,
Blackstone, BlackRock, State Street, and Vanguard. So that's where the local banks and the credit unions step up the bat, where we can't step up the bat. I mean, there's some debt lenders out there that'll do it, but like it's very far, there's far and few between, because a lot of these deals are fantasy like. So I want to build this beautiful warehouse, but I got no experience, but I know the contractor does, and the story starts escalating, and it gets very muddy. You know what I mean?
yeah,
So
yeah.
how are you handling challenges in construction lending today, and what do you look at? What do you see over the next 24 months residentially? And let's stick to residential and mixed use with a residential blend. Okay, like an eat, work, and live type of thing, or a conversion or something like that. Anything on the warehousing side, or real true office retail, it's not really the room for that. So let's
Got
just
it.
try to keep it within, the people that that can kind of relate to it. So let's go with
Got
that.
it. Okay, cool. Yeah, I would say, we're guiding people to focus on your takeout, because what is meaning what happens after your construction loan matures, and the reason we want, I always like to focus on that, and make sure our clients are focused on that, is because if you're looking at exit value, you're looking at stabilized value as well. Making sure you have enough delta between going in and exiting. There's so much that's going on in the market right now with, rates, values, sort of aberrations, ups and downs, rents, where rents are moving. We just talked about this whole supply story of a lot of supplies coming, a lot of concessioning. So, my first comment is, with our clients is like, let's look at, okay, great, we're selling this great piece of dirt that you're going to go build, 20 units, 50 units, whatever it is. Let's spend some time to figure out what your business plan is and what that stabilized value looks like and what your exit value looks like, so you can make sure you structure the right debt with your lenders so you've got enough room. Because sometimes people don't focus so much. You don't focus as much on that exit piece, and everybody focuses on the going in and what's it look like. But what about the exit? How do you get out of it? How do you pay your lender off? And how do you pay your lender off when you have to, you know, nobody wants to do this, but drop rates sometimes when there's too much supply, or do a little bit too much concessioning, or you hit some schedule issues and you accrue a little bit more interest than you wanted to. So I would say focusing on there. The other side of that, we're getting around or dealing with some of these deals when we talk about mixed use and some of the 20, 30, 40 unit multifamily deals is outside of on the outside of certain lenders, the bank lenders are great, but you'll go back to your relationships. Go figure out where your relationships are, where your contractors' relationships are, because I think that helps. An environment like this, relationship lending is really important. Really really important. Being able for your loan officer to tell the credit committee a really good story about you as a sponsor and what you've been through and how you handle situations is really key right now in the market. So I would go back and focus on that kind of stuff.
Great stuff, Antonio. Thank you very much. Bob, good morning, and thank you for your patience. I appreciate you listening in here, and he's always been a great fan of our group here. First, introduce yourself, who you are, what you do. I'd love to see if you have a question for Antonio and how it could relate to the room and kind of feedback to what you do in your everyday work.
Thanks, Joe. So my name is Bob Chesick. I'm president of Chespin Corporation. I help people set up LLCs, corporations, and now navigate through the BOI structure. I'm not here to give any legal advice. And Antonio, I think when you said Andy's Diner, or when you guys are saying Andy's Diner, I think you actually were at one of my presentations that I did for Joe. I did it at both Conshohocken and Trevo. So I think I caught you somewhere, I met you somewhere down the road there. Cool. Well, Joe knows everybody, so that I wouldn't be surprised by that. Yep. Yeah. So my biggest question, and I'm not a real estate investor. I come more from the service provider end, doing the LLCs and the corporations, all that. My question to you is, when somebody comes at you with a deal, what's the one biggest mistake you see people making when they're trying to put one of these deals together with you? So when somebody's trying to buy a deal, somebody's trying to buy like what's property? Yeah. Well, what are they unprepared with usually, or have done incorrectly that you normally see that has to either be fixed or derails the deal? Yeah. When somebody's first starting out and they're looking at something, I think they're missing. Most people miss the like how you actually operate component. Because in the beginning, when you're just starting out, everything's just numbers on a piece of paper, right? Like you're putting a whole lot of numbers on a piece of paper, and you can massage it and make it work, right? Because garbage in, garbage out. Like you're plugging numbers to make it work. But how it actually operates and how you actually are able to, run a 30 unit or 40 unit new building or mixed use community that you built, like that's a whole different story. So that's probably the biggest. The second, if I can answer too, if that's all right.
Go ahead.
The second close to it would probably be structure. So like if you're a new syndicator or a new sponsor, you haven't done this pretty consistently, or maybe it's your first time. We've seen a lot of clients come to us and not have their stuff together, if you will. So, and what I mean by that is all that back end stuff, the administrative stuff, how you actually structuring the deal. Where are you going to get your money from? How are you going to get your money? The physical legal structure, all your entities in place, like if not having done it already, what's your plan to get it done? Like demonstrate to me, to the client, to the seller, to the whole team here that you have your stuff together and know how to execute it. Because sometimes it's okay if you're starting out and you're fresh and you're young and this is you're new at doing it, but demonstrate that you know what the next steps are. And sometimes structuring entities, the legal component of all, gets overseen. Thank you.
Bob, are you going to have a room after this as well?
Yes, I'm going to do a room as soon as this one closes. I scheduled it for 10, but whenever this is over, the BOIs were approved by the courts and there's a deadline set. So we're going to be talking Corporate Transparency Act, the new deadlines, and going to be talking about Delaware's response to Elon Musk, which is a whole other world we're getting into now.
Well, and that leads to a question I have for Antonio too, Bob. Perfect timing. So, Antonio, in regards to Doge and government overhaul and its ripple effect on the real estate investor, how are you seeing it 30 days in right now with your clients, and how are they reacting to it? I mean, I'm seeing all positive. I'm not seeing a heck of a lot of negative. I mean, the media is trying to, I guess they're talking to themselves in the mirror, because anybody I talk to, they're ecstatic about peeling the onion. So, what's your thoughts on this, and how you think this is going to impact over the next 20? Because they can't do anything against Doge for 18 months based on the executive order. So I don't think people realize he can't. That whole thing can't be touched by Congress for 18 months. Yeah, I mean, I feel the same way. Everything I've been hearing and everybody I've been talking to is pretty positive. I think the impact is probably more significant in the DC, Virginia, markets, but in general, it's definitely going to be an impact. And I think everybody thinks it's positive. Like cut the waste, peel back the onion. I don't think there's going to be an issue with that. I mean, the next question becomes, what do you do with all those buildings? And I think multifamily is probably the logical next answer. But I think it's positive in general. Well, I think a lot of these government buildings could be converted to some form of medical senior related stuff like assisted living,
Yeah,
hospice, um, that type of direction. Because I don't think we really have enough of that. And those buildings are set up more into that direction than converting to more multifamily. 'Cause you'd have to tear those things apart. You wouldn't be able to run the piping the right way. So, um, I mean, do you see some of that, the senior stuff? Because we're an aging country, of course. Do you see that coming to the front line as well? You're seeing more inquiry on the senior environment, whether it's hospice related, assisted living facility, some type of facility of senior care. Are you seeing that
yeah.
coming present right now?
Yeah, I think that's definitely happening. It's definitely happening. Medical's a space that we've seen pretty strong, and that's a really good use for a lot of the old vacant office space that literally can't get leased or sold. So and medical tenants, medical operators tend to invest a lot of money and be very sticky. So that's a really good use for a lot of those spaces. The seniors housing and skilled nursing and 55 plus and aging care. There's definitely a need for that, no doubt. You need to be a little more skilled, specialized operators, so we see a little bit less of the inquiry from it. But I think you're right. I think you hit the nail on the head. That's a great use for those buildings, and I think that's something that we're going to see more growth in.
So we'll go to our next moderator, Mr. Chris Caggiano. Brief overview, who you are, what you do, and what's your question for Antonio this morning in regards to commercial real estate?
Hi, my name is Chris Caggiano. I'm president of Grand Oaks Funding, based out of New York, licensed in New Jersey, Pennsylvania, and Florida for resi, do commercial also. I do business with Joe. I love the process. It's so streamlined. It's a pleasure doing business. We run on a lot of events together. I'm also a realtor, taking care of New York, Staten Island, Brooklyn, Manhattan. And I'm really curious to know more about that DSCR loan, 20 units. That would be awesome to see. Not have to go to a regular commercial lender because they take so long to get loans closed. But I'm really excited to hear about all these different topics this morning, and especially in the investor side, because I think that's where the basis of the business is right now.
Do you have a question for Antonio this morning in regards to anything we're discussing right now?
I think we covered a lot. I think I'm good right now.
Okay.
But enjoying the conversation, listening in, and look forward to being here. Every Sunday that I can make. Thank you.
Thank you. And I do agree with you. I think the DSCR is going to take a bigger role in the multifamily small balance. I think it's happening as we see it because they know we have to do it. Okay. Because Fannie and Freddie and the banks just can't get to the front line quick enough. And Antonio, I know we were working on a very unique deal with Glenn. Did that deal ever come together? I think it was overpriced, and that's why the DSCR was a little wacky. And it was terrible, actually. You'd have to bring 35% to make sense. Are people waking up realizing they're overpriced? I mean, is that happening or is that not really happening yet?
Not really.
Okay. Yeah, still a little stood on.
It's still a little bit.
Okay. Yeah, it happens.
The sellers don't help either, Joe, to be honest. They don't help either.
Yeah, I mean, that deal okay, great. It's in Newtown. So you're paying for the prestigious area, the safety of it all, the consistency of it all. But you'd have to have 35% to make money on this thing, and then you're chasing that 35% for the next 5 to 8 years. And if you have vacancy or anything catastrophic that had to be done to the building, now you're really chasing your money for a long time, even with depreciation.
Yep. The problem is, when is the last time a building like that hits the market in Newtown? That's the people they want it and they stretch to make it work because in certain pockets we got a ton of supply, but in certain pockets we've got no supply forever. So it's no new supply forever. So it's they're buyers still try to make stuff work, and I think there's still that little bit of imbalance, but sellers don't help the equation at all either. Still.
Yeah. So let's go to our next moderator, Mr. David Ingamy. Good morning. Welcome. Brief overview who you are, what you do, and your question for understanding commercial real estate with Antonio Dicianni.
Hey, good morning, everybody. As Joe said, my name is Dave Injemy. I am a licensed title insurance and property and casualty insurance agent, and I could get you a quote for homeowners anywhere in the country. I could also handle title insurance anywhere in the country. And most recently, I joined Joe Scarice's team. I am helping him to process loans, and in the near future, I will be also writing some loans for people who need that funding. So I think it's a great conversation. I don't necessarily have any questions for the moderator, but or for the speaker, I should say. But I can say in the last 3 weeks after joining Joe's team, I am talking with more and more investors, and the difference that I see from one side to the other, meaning from the investor side to the primary homeowner crowd, is like night and day. There is a lot of activity on this side of the fence. There's a lot of excitement, as Joe said, and the QM products are definitely sought after. It's such a refreshing change in activity and positivity rather than the residential side that I've been dealing with for the better part of the last 15 years. So yeah, I'm excited to be on this call. I'm excited to hear about some of the things going on, like we're talking about, and just as somebody that's dealt with both sides of the market over the last few months, I can tell you that this is definitely the place to be. It's a business mentality rather than an emotional purchase, because a person's going to be living there. So if anybody has any questions for me, feel free to to put it in the chat or give me a call.
Thanks, Dave. And Antonio, that relates to a question I have back to you. Where are you seeing people that you haven't seen in a while come off the sidelines? And say you had a good or bad experience with them, they just suddenly have human amnesia and they want to work with you again. And are you seeing that? Because I'm seeing that in the last 2 weeks. I got people that told me to go scratch 2, 3, 4 years ago. Suddenly, I'm their best friend in the whole wide world. I mean, are you seeing that happening over the last month or two?
Oh yeah, definitely. I can't say that we're doing more deals now, but we're having more conversations. Hopefully, those people aren't tire kicking too much. But I think they're something clicked, something changed. I don't know if it's just a little more confidence in the market, administration. I don't know what it is, but something clicked, and we're definitely having more conversations. Yeah, I'm glad you are too. It's a good thing, I think, for our business.
Yeah, I did close to 110 million in origination last year, right? And why I brought Dave on is because of his background, because I think there is a unique opportunity for in our space to broker loans and white label loans. So since you're allowed to do that through a direct lender such as ourselves, I'm looking at Dave to enhance our broker channel because I don't think enough brokers understand the convenience of white labeling with a direct lender. Are you seeing agents in your space starting to broker loans because of the non-QM presence in the market?
Yep. I think everybody tries to do that. Yep, absolutely.
Yeah.
Yep. I mean, so to caveat that, the key is hooking up with somebody who actually knows what they're doing.
Well, that's I'm still trying to figure out what I'm doing every day. But yes, I would agree. Listen, people send me stuff and I'm like, how do these people wake up in the morning and don't set themselves on fire by turning on the stove? So I'm like, oh my gosh. I'm like, they send me this and they think I could decipher whatever they're sending me. And Dave actually he's like, how did you figure that out? I'm like, well, I used Google and I kind of taped it together and I kind of made sense of it. But people really don't know how to stack a loan for somebody to look at to understand. Like when you say, hey, send me an executive summary, they literally send me attachments and they're like, I'm going to open all these attachments. Like, what am I looking at? I don't even know what I'm looking at.
Yeah.
Just break it down to bullet points.
Just like realtors in the world, right? Like there's anybody, not anybody, but a lot of people are realtors. Like who's the good ones? Who knows actually how to help you through that deal? Same thing on the debt side. No different.
Yeah, it's kind of crazy. So yeah, I giggle sometimes and shake my head, my eyes roll around. That's all by 9 a.m. in the morning on a Monday or Tuesday. So Yeah, by 10, forget about it. I'm already looking for a shot of bourbon just to kind of balance out the blood pressure. So it's all good. But then we'll go to our next moderator, Mr. Kazi. Brief overview, who you are, what you do, and your question for understanding commercial real estate with Antonio Dicianni. Kazi?
No, no worries, buddy. Hey, my man Joe, what's going on?
Good morning.
I'm doing pretty well this morning.
Good. Good morning. How are you? So yeah, we just want to kind of get a brief overview who you are, what you do, and then a question for Antonio based on our discussion this morning.
Okay, yeah. No, I definitely came into the room late this morning, so I sound like I missed a great conversation. Pleasure to meet you, Antonio. I'm Anthony Casey, based out of Wisconsin, affordable housing developer. Work in a few different markets, and so our main focus is really just new construction with long-term housing tax credits. That the reuses, marrying historical tax credits with low-income housing tax credit, and naturally turn affordable housing as well. So you really didn't have a question, but just want to see. Dude, Tony, I'm curious though. What kind of lender, are you, or what part of commercial real estate are you in?
Yeah, I run two sort of platforms under Suburban City Group. We've got a brokerage division on commercial real estate, so sales, leasing, development, site selection, advisory, consulting, mostly all asset classes, but we tend to focus on multifamily, land, mixed use, and some small bay flex. We've been building out pretty aggressively. And on the other side, I do development investment work, both on the principal side and then working with co-sponsoring with people who want to get started and structure the right way. And we focus on that platform on mixed use, multifamily, and built for rent.
That's pretty awesome. What markets are you in?
I'm in suburban Philly and coastal Carolinas.
Okay, no, it's pretty awesome. Pretty awesome. Yeah, we haven't worked on markets before, but no, I definitely shoot you a message offline and see if there's a way we can collaborate. Across some of these other markets. But I haven't worked in Carolinas or Philly, but I guess some interesting stuff happens over there for sure.
Yeah, cool. That's great. Yeah. Nice connect with you.
So, Antonio, we're coming up to against the 10 o'clock hour. Just want to still get some questions for you here. So, if you were a licensed real estate agent and you've been on the residential side, you're seeing home ownership flattening a little bit, and you want to kind of dabble into the investment space, what would be the best advice first to a real estate agent that would like to take on some investment channels or commercial real estate channels? What lane should they stay in so they don't kind of go above their pay grade kind of thing?
Yeah, good question. I would start with the product, what's closest to the product that you know already. And I think selling single family rentals is a good route to start in my opinion. Most people, if you came from being a residential realtor, know how that product works for the most part. Now, when it becomes a rental, there's nuances you need to learn. But that's probably the closest to what you know. And if you're going to shift lanes, put your turn signal on, meaning talk to people, learn some things. Don't just dive into it and pretend like you know how to execute it, because you're going to get messed up and trip along the way. I would do things like this. Jump on channels like this, watch YouTube videos, talk to guys like yourself, Joe. Learn about how they finance. If you don't know it already, how they finance, and the things that your buyer and seller both need to be aware of from a financing perspective, which is sometimes the most critical piece. Obviously, a critical piece in the transaction. Talk to an appraiser, learn about how they're going to value the asset a little bit differently, maybe a couple different approaches than your normal residential sale. You'll get comfortable with the leases, that kind of thing.
And my question for the real estate investor that's listening in, they have 5 to 10 properties, single family through two family, and they want to scale. They want to either get rid of the W-2 job that they have and supplement it full time into real estate. What are some of the suggestions you have as a real estate professional to take that individual to scale and get them to a level where they could supplement their income? And what would be an approach that you would do to sit down? They have the liquidity, they have the credit, they have some of the experience that they need. What would be some steps that you would do sitting down with them to take them to the next step?
Yeah, good question. I would start by trying to figure out breaking down, let me put it that way, breaking down those short and long-term goals, and really getting into the nitty-gritty of the financial piece of it, what you're looking to achieve and why, and break that down on both like a 3, 5, and 10+ year periods. I think you got to break it down so you can kind of reverse engineer and work backwards on how you put out money to get there, and then from there, I would help the client define what investments and how well of a balanced portfolio you need to build to achieve those things. Define your, as people call it, the buy box. Define where you need to put that money into to help achieve those goals, and then be really, really strict on your buy box. It's got to have a really compelling reason to go outside the buy box, but really focus on staying within that buy box, and then go look at a million deals. Look at a million deals both on the passive side, the active side. I like to guide people who are trying to transition out of W-2 into the passive side, to be candid with you. Let that W-2 generate you the cash to go drive back into passive investments. Keep that W-2 throwing cash, throw it back reinvest it into the passive investments according to your strategy, according to your buy box that we develop. And then before you know it, you're ready to transition out full time. If you want to take an active role, take an active role. I just think people make a huge mix up by trying to be too active on a W-2 and don't realize the amount of work that goes into running successful active investments. But work on the buy box, look at a million deals, get comfortable. Once you see those deals in the buy box, you pull the trigger, and there's no doubt about it. It's in your buy box, it aligns with your vision and your strategy.
Great stuff. And then what's the best way to contact you, reach out to you, set up a call to action discussion, direction, team up with you and your team as well to kind of start identifying opportunities?
Yeah, absolutely. Thanks, Joe. You can reach me Antonio at suburbancitygroup.com, or on my cell 215-962-7373, or hit up our website www.suburbancitygroup.com. You can check out all the different sort of platforms we run, and there's links there to get in touch with us, schedule calls. Happy to talk with anybody about really anything. Just getting started, pick my brain. Maybe you're working on a deal you need some assistance on, or you need be put in touch with the right people. Happy to help in all those regards.
So I want to thank Antonio Dicianni for coming on this morning. This was kind of a thing we put together. It's hard to get together for the mastermind discussions, with all the elite deal maker events we're having. Antonio, we're actually booked out with speakers till June at all the events.
That's great.
Except North Jersey. So we're working on North Jersey now and building that out and getting that set up. Funny enough, we actually have a white label course, how to teach professionals how to broker our money and white label our money. Our next class is actually March 15th up in Hasbrook Heights, New Jersey. So we're doing a North Jersey event on white label marketing. And then in April 26th, we're bringing it back down to South Jersey. We're going to have it at First American Title in Haddonfield, where we're going to be providing white label training, how to broker loans, how to underwrite deals, how to understand DSCR, understand fixed to rent, fixed to flip, multifamily, new construction. Both are on Saturdays. So if you were coming in, you can come Friday night, stay over, come to the Saturday event. It's a full half day. We start around between 9 and 10, and we get done around between 12 and 1. So there's plenty of opportunity to educate yourself and have another opportunity of being a smarter real estate professional and understanding the backbone to lending. The class we had in Philadelphia, I think last month, we had 45 people, a lot of excitement, and a lot of really great questions. And you want to come there and you want to be humble. You want to kind of really take in the information because it's so beneficial to understand non-QM at this point and understanding where, if you could talk the language in non-QM with somebody like Antonio, he's going to be a little more responsive when you're on the phone with somebody and he doesn't know you from anywhere, right? I mean, Antonio, let's be honest. Yeah. The initial conversation is so important. People don't realize, like, when they call somebody, introduce yourself. 2, have some knowledge of what you're talking about or the subject of the property, right? I mean, like, just don't throw crap up on a wall and hope it sticks, right? I mean, that would be.
Yep.
you know,
Yeah, absolutely. Love working with new people, but just, demonstrate that you've done a little bit of research prior,
yeah, they think you're telepathic and you have a crystal ball sitting next to you, and sometimes you're like did I miss something? You didn't even I don't even know what your name is. I'm like, okay, so but I really appreciate you coming on today, and we're gonna have another follow-up room with Bob Cheswick this morning, and I want to thank our sponsors. I want to thank Miss Linda Plagas of Realty 411. I'd like to thank MB Capital, where I'm a referral partner in the unsecured business line of credit program. I'd like to thank Lendmark, where I'm a senior loan analyst providing asset-based lending nationwide. I'd like to thank Mr. Yardell Perkins, of course, from Perkatech, my business partner, colleague, co-host, co-founder of this great podcast. I'd like to thank Clubhouse for allowing us to provide an alternative version of audio to our clients on our podcast. You can find our podcast above. We're nearing 100 plus episodes. We hired a social media administrator to push all this content out. You can find us pretty much everywhere online if you do a quick Google search. We'll be back here every Sunday morning, of course, 9 a.m. Eastern Standard Time, providing insight, education, networking, and strategy. My quote today: my past has not defined me, destroyed me, deterred me, or defeated me. It has only strengthened me. Everybody have a blessed Sunday. Antonio, have a great day. Everybody else, go to Bob's room following this, and I'll be ending the room in the next 30 seconds. Thank you.
Cool. Thanks, everybody.